Alrighty, hello everyone and good morning. It's great to see many of you, and thank you so much for making the effort to wake up this early in the morning, because I know that many of you probably went out last night. You know, some of you also had a few drinks, and I know, it's not as easy to get up in the morning. So today we're going to be talking about fundraising. So how many of you are fundraising? Raise your hand. Okay. So it's not a good idea to say that you're fundraising. We'll get into that in a little bit. I was just saying, playing a little trick with you guys. So basically today, what I want to make sure is that when you guys come out of that door, you have an idea of what you need or what kind of actionable items or what you can do to really step it up on the fundraising and increase your chances of getting financing. So basically the experience that I'm going to be using, for those of you that is the first time that we get to really see each other, I'm going to be talking from some of the experience that I have accumulated over the past 10 years, mainly from building the previous company was a venture-backed company, so we basically created one of the largest ecosystems supporting entrepreneurs. We were basically helping from the beginning all the way to the end in the journey of really building, financing, and scaling your business, and also exiting your business. We were financing like 4 companies a month and stuff like that. So it was really cool. Then also from the book, The Art of Startup Fundraising. So we will be getting some of the highlights from this book that was published in 2016. And then also from the Deal Makers podcast, which is this podcast that I launched actually recently. And there I interview some of the most successful entrepreneurs, where they basically share how they did it with all of the makeup and all the noise that you would typically read on the press. Because what you really read on the press is what they want you to read, is really not what happened behind the curtains, no? So with that being said, I always like to start every presentation with a little quote. And I really like this quote because when you are fundraising or when you are seeing other people raising money, it really seems something like very distant. But I have to say that at the end of the day, it always seems, just like the quote says, it always seems impossible until it's done. And then when it's done, you look back and you're like, wow, maybe that was a little bit challenging, but at the end of the day, it was manageable, right? So with that being said, I want to start with giving you guys a little bit of visibility as to what you're going to be encountering, what that funnel looks like. So when we're thinking about the funnel, let's just start with sharing here like a little bit of data of how brutal it is, right? So 65% of companies, as you see up there, fail because of lack of access to financing. There's a ton of data that has been published, and on that data, you would actually see that this is the biggest reason. Obviously, there is execution, there is many factors, there's market conditions that can really come into place, but at the end of the day, I find that financing is like having a heart. You need a heart to be able to function. And if you don't have financing to really pay whatever costs are coming up and execute, it's going to be really tough. Now, you can bootstrap your business, and that's completely fine. But when we're thinking about a hyper growth journey, it's very challenging to do that without any financing, external financing. So if we take a look at the funnel of VCs. So for example, when you're thinking about, let's say, pitching or trying to get in front of a venture capital firm. So this is basically where you're going to be looking at. So it's pretty interesting because everything starts with the screening. So I guess the social proof is key. The VC is always going to think like, okay, who introduced me to this guy or to this gal, and we'll get that in a bit. But that really determines the amount of time that they're going to dedicate to you. So then after that initial screening, you're going to go into the socialization, which is the initial meetings that you're going to getting people excited, and then eventually keep going with the follow-up so that would get you, hopefully the money in the bank. Now, I have to tell you guys something. At the end of the day, what separates you and the money is the concerns in between. So every single meeting that you do, every follow-up that you do, that's going to give you more chances to address those concerns to get the money in. The diligence process, I have to say that it happens from the minute that you step into the investor's office, whether that is via an email, whether that is via a call, or during an in-person meeting. these guys, they're really big experts when it comes to pattern recognition. I remember one of the first meetings that I had when I was raising money for one of my previous companies. It was actually in one of those VC firms there in Silicon Valley. And I remember I sat down. So the last business, I actually built it with my wife. So obviously this is not a recipe that I recommend doing at home, but for us, thank God, it worked out. But basically we sat down in the meeting, and you see like all the IPOs framed in the conference room of all like these really big companies today, but back then they were like small companies. And I was like we were very impressed. So this guy comes in, sits down, and just without saying anything, he looks at us. And at the time we were dating, he looks at us and he says, "What's the relationship between the two of you?" Just like that. I was like, how the hell does he know? No? And I said, well, we're dating, right? And I was just impressed at how quickly they really recognize certain patterns. And so he replied to us, and I think that at the point, the guy kind of like felt bad because we were very ignorant of what was ahead of us, because he was the first company at the time. And he says, well, I got to tell you guys that this is going to improve for the good or for the worse your relationship. And at that point, obviously, I didn't know what he meant, but eventually, a couple of years later, I sent him a video, and because the proposal that I did with my now wife, it was all caught on camera, and I said, hey, you were actually right. In fact, we are getting married. So, obviously for us, it did change it for the good, but the reason why I'm sharing this story with you guys is because they are experts, people that are sophisticated when it comes to investing in startups, whether that is a VC, an angel group. These are like masters when it comes to pattern recognition. So when we're thinking about the diligence, I don't think that the diligence happens the minute that, let's say you get a term sheet and they're excited about your business. It comes the minute there's that first contact with the investor. Now, the decision, it really depends on the investor that you're speaking with. For VCs, typically it's going to be at the partners meeting. They do them like on Mondays or Tuesdays, but that's what you're looking at. Now, this is basically the percentage of the companies that end up getting financing. So typically on average you see, and from VCs, so typically on average you see about 1,000 companies that a partner would be looking at on a yearly basis. A partner at a VC firm probably is going to do anywhere between 3 to 4 investments because they can't really scale themselves, right? Because they need to be part of those board meetings and be overseeing what their money is doing with that company and so forth. So when we're thinking about what is really separating the people that fail from the people that succeed is one simple thing, and that is storytelling. So it's being able to, because the guys, the best entrepreneurs that are out there, those are not like the best visionaries, the best guys at just telling you what the future is going to look like. Those are like the best ones are the ones that are able to tell you a story that has a sense of change, that has an alignment, that has a vision, that has something compelling. Because when you're especially looking to raise money for an early stage company, the truth of the matter is that people don't care about your past, people don't care about your present. What they really care about is the future, because the future is really all we have and what it matters when you're at an early stage. Then when you're a little bit farther, then perhaps like more the numbers and what you've done and your execution capabilities of your management team and all of that stuff. But when we're thinking about, for example, seed or Series A, it's all about the future, and that's all about storytelling. So, some good examples of this. So I think that when we're thinking about the business modern era, there is probably 2 unbelievable storytellers. And that the first one there is Steve Jobs, and you can, for example, take a look at the presentation that he did on like when he launched the iPhone, right, back then. And how the linguistic also that he uses, because it's not about just telling the story, it's about how you enhance the story so that you get people off their chairs, off their seats, and you get them pumped. And if you take a look at, for example, going to YouTube and you just take a look at, for example, the speech that he did, the linguistic that he uses, some of the words that he uses to capture people's attention, like this is revolutionary. This is one of the first time that whatever, is happening. That just gets you awake. And that's really amazing. Another one is Elon Musk, obviously. And what I like, for example, about Elon Musk is the authenticity that he uses when he's really, speaking in front of people. I mean, you could see, for example, his presentation when he was launching the Tesla Powerwall, and he was just there, and it seemed like you could be one person in the crowd, and you just felt like you were literally like talking with the guy. It's really, really powerful, and you never know where your investors are going to be at. They can be at an event like this. They can be, for example, introduced and it's just a one-on-one conversation, but you just need to be able to interact and pitch your story and master that storytelling wherever you are, and just, with the same level of, I would say, energy, and also with the same level of just being able to capture people's attention. What I also liked about, for example, that presentation that I was sharing with you guys is how you're able to demonstrate what your product or service or company is capable of doing. So, for example, if you take a look at his presentation of the Tesla Powerwall, he literally, at the end of the presentation, he goes, by the way, guys, this entire event has been powered by this thing. And at that point, you know that thing works. You know that there's this unbelievable amount of people, this incredible amount of electricity that is being used, and how the guy is just being able to just demonstrate, and showcase the product just like that. It's very powerful. So I think that every story, I think that it's really captured in a pitch deck, because a pitch deck at the end of the day it's going to be the first time that they are exposed to whatever you're doing. They can see how you are telling the story. They can see the flow of your story. And I find that, unfortunately, many folks, they don't get this. And when you don't get it, it's just very tough, because normally, on average, people are going to be investing on reviewing your pitch deck around 2 minutes and 40 seconds. That's all it is. You have 2 minutes and 40 seconds to convince someone. And the reason why this is important is because you may be forwarding your presentation to someone, but you never know if that someone needs to send it to someone else. So then the issue there is that if you're not able to have a proper flow where you can just like skim very quickly through the entire presentation, you're going to lose people. You're going to lose people, and you're going to lose the potential of receiving that investment. So when we're thinking about the pitch deck, and by the way, pitch decks today is the way to go. If you have a business plan, or if you're working on your business plan, there's a trash can then at the door. Just throw it on the trash can, because it doesn't work anymore with investors, guys. No more business plans. I hate when someone tells me, hey, I'm working on my business plan. It doesn't work, because the thing is that, especially when you're doing a hyper-growth company, overnight things are going to change. The market is going to change. Your company is going to change. And you need something that is flexible, that you can iterate, on and on. So I think that business plans, for example, today, they're very good if you want to use them for like an internal roadmap that you want to share with your colleagues and maybe like existing investors. But I think that if you really want to pitch your story, if you want to get investment, you want to get a pitch deck that tells a story in a very powerful way. So when we're thinking about the pitch deck, so I hate to see people when they send me a pitch deck, right? Because now with this company that we're building, which is the big vision for Panthera, is the Blackstone for startups. So that's what we're doing. But now we've started with this advisory thing, and when we receive the pitch decks, what I hate is when they send me something that has more than 20 slides. Why? Because you just get lost. You get lost. So my recommendation to all of you here is that whatever you do, just make sure that you're able to capture your story in 15 to 20 slides. Hey, nobody cares about all the features in the world that you're doing, because your duty is to capture the investor's attention right there. And again, you want to continue getting that investor excited so that you get more meetings. In that one single touch point, is going to be very difficult to capture the attention from someone with every single feature in their mother that you have. So my suggestion to you is just keep it very 30,000 foot view type of level. And then, for someone to get it, to get excited with it, and to have a call to action at the end, so that they're like, hey, you know what? I get what this presentation is all about. I really want to, continue to get to know this guy, or I want to involve some of the partners in my firm so that we can all get, potentially excited as well and make an investment in this company, So basically just going really quickly through each one of the slides. So the cover, funny enough, I hate to see people just putting their name and the logo of the business. That's a really big mistake. The cover of the pitch deck is actually much more important than what you guys think. And the reason for that is because with the cover of the pitch deck, you are creating the expectations for what the investor is about to review. You're missing out on the chance of telling the story, of telling what your business or what that story that they're about to read is about. So the way that I would typically suggest going about this is, and by the way, let me ask here, how many of you guys here already have a pitch deck? Raise your hand. Okay, great. How many of you are working on your pitch deck? Raise your hand. Okay, great. So hopefully we get your minds raising after this one. So on the cover, very quickly, so you want to put in there like a high resolution picture, kind of like showcasing what your company's about. There you put your logo as well. I would really recommend you guys to put a tagline. So for example, a cool example of this, Uber, like everyone's private driver. So something like that, that is really in essence, like in just like 3 or 4 words, able to tell what your business is about. The other one is the problem. So the problem, it needs to be one. It's not like 3, 4, or 5. So imagine yourself removing you or your business from the market. What is that problem that exists out there? You want to put just one single statement in there so that people get it. Because at the end of the day, it's for whoever is reviewing the presentation to kind of like realize, hey, I've dealt with this problem. Or I know someone in my family that has dealt with this problem. And that is so powerful. I remember I was, back then, I was a judge at this competition of business plans. And there was this this girl that just finished, she just got graduated from college. And she started telling her story to the crowd and to everyone. And this story was, basically she started with the problem. The problem, she said, was that she had a sister that was dealing with some, I believe it was like mental challenges, and that created a whole lot of frustration because they couldn't find the right type of help. And basically what she decided to do was to create a marketplace where she would connect the people that could provide that help with the people that were seeking that help. And just the way that she was able to tell that story, it brought many of the people in the crowd to tears. Because we all know someone, right? Or maybe, we've gone through a depression or from something like that. So, and founders, unfortunately, deal with a lot of this. So it's being able to capture the attention from someone and having that sense of relatedness is just so important. The solution is what you're bringing, what you're doing, the experience. Help them, whether if you're not able to be there in person, don't put videos so that they're like, okay, I'm going to watch this video. Because one, video takes a lot of space. And then 2, you just don't want that to happen. You're going to lose people's attention. You just want to maybe like create like a really quick, I don't know, like 1 paragraph or like a picture so that they get it. They understand what your business is about. And then the other stuff, process, technology, business model, I think is very clear. And then market size. So if your company is not operating in a market that has that is at least over 1 billion, I think that you guys should forget about the VC route. Because they just don't want to touch it. It's just not going to help to justify their potential 10x or 20x or whatever their investment thesis is looking for. So market size, always 1 billion plus. And if you're not at the 1 billion plus, maybe you're thinking too small. The other day I met with a founder and he was like, oh, my company is operating in a $500 million market. And I said, you're just putting yourself in a very niche spot. And that is what is narrowing and limiting your potential market. Because here's the thing, you may have the best product in the world. You may have the best team in the world. But at the end of the day, if your market is too small, that is also going to limit the potential returns of the investor. And that's why they're probably not going to want to invest, even if you have the best team in the world. Now, competitors, I think that this is very interesting, and you want to use psychology here. So basically you put it in a quadrant, you put everyone, and you put yourself up at the top right. because that's where always the eye goes to. Now, don't try to not put everyone, don't try to, maybe I'm gonna put some, maybe I'm not gonna put this guy because he's a little bit stronger than I am, because they're gonna think that you didn't do your research or that you're like kind of like out of integrity, really creating that slide. So you do not want to fall out on the trust, on the relationship that you can create with the investor when they're reviewing your materials. And then the other stuff is the traction, the team. For example, I would not put everyone and their mother in your team, because that is very tricky. Typically, when you're going out for fundraising, you need to estimate about 6 months. So that's typically the average that it takes to raise a round of financing. The problem is that if you're putting everyone on your team, and especially if you have, let's say, like more than 4 or 5 people on your team, startups, they're like a revolving door. Unfortunately, people come and go. That's just the way it is. And if you're in a place like the Bay Area or something like that, it moves even faster. It's unbelievable. The problem is if you have people on your presentation that are not going to be there, let's say, and you're not for sure that they're going to be there in the next 6 months from now, you do not want to include them on the presentation. Because the problem is that if an investor is viewing your presentation, they see a face and they don't see that face anymore, then they're going to ask you why. And what you're doing is you're not removing the concerns, which is your duty as a founder when you're raising money. You're adding more concerns and you're complicating yourself. So don't do that. So what I would recommend on the team slide is just put the leadership team or put the co-founders, because you know that these guys are going to stick for the long run. Then the other thing is the advisors. I think that advisors are great because it establishes some type of social proof. So you're going to be able, for example, if you have some names that people may recognize, then the investor may just grab the phone and say, hey, what do you think about this company, right? So that helps with that kind of stuff. And then the other stuff is the financials, how do you break down the capital raise, and then the thank you slide, no? Now, let's say here, so there is this slide that I'm about to show you guys. That is, it has basically captured all the data from hundreds of pitch decks. And this was done by Doxen. And basically, they tracked where the attention of the investor went. And there were 2 slides that investors were spending the most attention on. And that was the financials and the team. So here you can see the breakdown of how the investors typically invest their time. Now, as you see there, definitely the financial slide and then also the team slide are critical. And the team slide is actually really important because just like the book from Jim Collins, Good to Great, the startups are like a bus without a direction, right? But eventually, if you find the right people to be seated in the right seats of the bus, that bus is going to find the direction towards success. And that's what it's all about. And that's what people know, because whatever you're up to today, guys or gals, is going to change tomorrow. So don't really get stuck with whatever you have now, because there's not a single pitch deck or whatever plan that is going to be bulletproof before you go out there. The other thing is the financials. The financials, I know, and I speak with many of you guys, and in many instances you're like, oh my God, but this is a startup. The financials are going to change. Our projections, probably this is going to be like figuring out smoke. Who knows? I mean, we don't know if we're going to be alive in 5 years from now on. I mean, hopefully yes, but who knows where we're going to be, right? So what I have to tell you here is that ultimately your financials is going to demonstrate how grounded you are. How well do you know your business? How well do you know your market? How well do you know the drivers behind your business? Now, there's many things here that are very important. And for example, the amount, within the, let's say, when we're thinking about the financials and, the amount that you need to raise, it's more important that you think the number that you go to market with. And in many instances, I see founders that they're completely lost about the money that they need to raise. And we're going to go into that in a minute. But what I would highly, highly recommend that you all do is that you just take a look at whatever money you require for the next 18 to 24 months of the business. And instead of just going with one single amount, let's say if you need to raise 3 million, right? So here this gentleman that looks very serious on the first row, you need to raise 3 million. So instead of 3 million, what I would suggest that you do, because if you go with one single amount and you say 3 million, then the people that are investing, let's say less than 3 million, in their investment thesis is going to be outside, so they're going to be, hey, sorry, but you're a little bit late for us. And then the people that invest more than 3 million, then they're going to be like, oh, you're a little bit early for us, right? Which is the phrase that we hate. You don't have enough traction. You're too early for us. It kind of like seems like you're dating, right? Like you're like on a Tinder type of thing, engaging with people, right? But it's all about putting a range. So in this case of the 3 million, you would go to market and you would speak with investors and you would say, I'm raising between 2 and 5 million. Why? Because then you're capturing everyone that has in their investment thesis that they invest under 3 million, and everyone that they have in their investment thesis that they invest more than 3 million. So you have a bigger range of people that you can actually tackle. So the expectations, and I think that the expectations are really critical when you're raising money, right? So I want to talk about the seed stage. So how many of you guys are at a seed stage? Raise your hand. Okay, so we have a few here, so that's good. So basically at a seed stage, what investors are expecting or hoping to see from you is that you have a solid team, or that you have some plans to put that team in place, that you've done your research in the market, that you have at least some type of like a working prototype that you can showcase, and that you have some form of a roadmap of what's ahead of you. So that's typically what you would see at a seed stage. Now, everything that happens before you raise money from VCs is basically a seed stage round. I don't care if it's from your family or if it's from an accelerator or from whatever. I mean, there's like different ways to call it: micro-seed, pre-seed. I don't like to complicate myself. I just call it seed. So basically with a seed round, you're going to be getting money from anyone that is not an institutional investor. Now, Series A. How many of you are at a Series A? Raise your hand. Okay. Do we have any investors in the crowd? Okay, no. Okay, yes. So now you guys know not only who to pitch, but also, like maybe if you're at a Series A, you know who to pitch as well. So Series A. So basically you have already the team. You have already the product in the market. You're starting to get some good validation from the market. Perhaps there's like a really interesting, there's really interesting data that you can provide about product market fit. So meaning that there is a demand for what you're doing. And that's something that investors are going to want to see, especially the institutional investors. And then the other thing is that you have distribution channels, because I see founders, they make so many times the mistake when the time comes for putting the breakdown of hey, I want to raise this amount of money and I'm going to be putting so much money to marketing. That's just such a mistake. You're losing people when you're doing that, guys. Don't do that. And the reason for that is because the investors, what they are hoping to find is that you have been able to identify an organic distribution channel that is going to give you an unfair advantage towards scaling up the business without really dumping a lot of money into marketing. And that's really critical. I mean, I remember, for example, for my previous business, what we created was like this really cool content strategy where we had like questions that were created on the platform, and it's called Co-Founders Lab Discuss. You can see it. Like you ask any question within an hour or so, you get it answered as a founder. But basically, every question counted as a page. So that was basically being indexed on Google, and it was just compounding growth. It was just beautiful, and people love that. So I'm just throwing that as an example so that I get you guys to think, hey, what can I do as an organic distribution channel? Because in our case, our competitors were dumping a lot of money. In many instances, they were investing like up to $150,000 in marketing, and we're talking about early stage. And we were investing zero, guys, zero. And that is what you need to identify. What kind of organic distribution channel is going to give me a competitive edge that is just going to be off the charts? When you go into Series B and beyond, who is here in Series B or beyond? Raise your hand. Okay, so maybe you're hiding. Anyway, so when you're at a Series B, an investor wants, they want to know, if I put this amount of money, if I put X, what's the Y? What's the output that I can take out, right, in terms of money? So you already have everything figured out. And for the most part, what you're looking at doing at a Series B and beyond is just scaling up like crazy. And in many instances, what you see as well is people that are trying to go after their international expansion. I think that going on with your presentation materials and with the story, when you're connecting with investors and saying, hey, I'm raising money to go overseas, or I'm raising money to do an international expansion. If you're under a Series B, you're shooting yourself on the foot. Don't do that. And the reason for that is because you're going to tell the investor indirectly that you're spreading yourself too thin, that you're all over the place. It's very tough at a seed or a Series A level to think about international expansion when you don't really have the resources from a team perspective, from a capital perspective. So that's typically what you will be doing at a Series B and beyond, and it's just basically scaling up. You already have figured out what a startup is, right? So a startup is a repeatable and scalable business model. So that's already what you have been able to identify and to crack the code at a Series B. And that's what you're going to be doing, just putting more money so that wheel that you've been able to assemble, it just turns faster and faster. It's not by adding more people, it's by adding more money, because that wheel is just going to turn. So when we're thinking about the timeline, right? So we've talked about 6 months, and that's the average. Now I have to tell you guys something, about this, and I want to give you guys some signs of warning that at least you keep in mind the minute you walk out of this door. And that is that things have changed, the rules have changed, and I think that you also need to keep in mind what are the market circumstances. So in terms of market circumstances, we are coming out of probably the longest bull run in history. Now, the problem with this is that there's a lot of people that are thinking that there's going to be a potential correction. The reason why I'm sharing this with you guys is because this means that probably if you are thinking that you're going to have to raise more money, don't wait until you have 6 months left. Try to go a little bit earlier. And not raise maybe like the 18 to 24 months. Maybe try to raise a little bit more so that you're giving yourself a little bit more oxygen to really make things happen. And look, at the end of the day, it's not about your company. It's not about, who you're engaging and stuff like that. It's also about how the market is reacting. Because in many instances, those VCs, their LPs, which are the people that are giving them the money for their funds, maybe they're going to, also be a little bit worried. And, let's face it, venture capital is a very risky thing. And when you're like in market circumstances where things are on a correction mode, that's kind of like one of the first things that potentially you're going to take a look at, reducing. So take a look at that. When you're thinking about the timeline and what are the different touch points that you're going to have, this is what you're looking at. From beginning to end. Everything starts with an introduction. And we're going to get into introductions, right? But everything starts with an introduction, whether that is an email that someone is sending on your behalf to connect you with the investor, whether that is a potential three-way call, or maybe you meet someone at an event like this. Then after that, when there is that contact being established, they may ask you for some type of materials so that they can get up to speed on your business. Now, I have to give you guys a little sign of caution here. I would not recommend sending your pitch deck to an investor before you're able to speak with that investor. Why? Because you don't know what are the intentions. You don't know what they're going to do with the pitch deck. You don't know that investor at all. Why would you send them anything? Just get on the phone first, understand what they're doing, what the interests are, if those interests align with yours, and then if there's a fit, they're interested, and then you like what you hear, and they may, or for sure they're going to ask you, hey, can you send me something as a follow-up, your pitch deck as a follow-up? Then you send it to them. Because you don't know if they're going to grab that pitch deck and they're going to maybe share it with someone that they know. Maybe that someone that they know has a portfolio company, and then they grab all your stuff, right? So you got to be very careful, very, very, very careful. Now, when you have your first call, it's all about getting that person pumped. It's all about getting them excited. It's not about, again, just like as I said with the pitch deck, it's not about sharing every feature in your mother. What you want to do is first and foremost is connecting as a human being. Because, as founders, I know you're excited to get in front of an investor, to tell them everything that you're up to, but they don't care. Nobody cares, right? They care about who you are and who you're being. And connecting on a personal level. And don't grab your pitch deck and try to shove it down their throat. That's not going to work. Do some homework. Where did they study? Do they have kids? Where did they go to school? Do they like sports? What kind of sports? Go to the goal. Knowing that, connect on a personal level. And then slowly it would transition towards business. And when it goes into business, you're not just like, hey, let me pull out my pitch stick. Let me go slide by slide. That's not gonna work. You're gonna lose them. What you wanna do is have your 30,000 foot view elevator pitch ready. Just very quickly, in 1 minute, you say, this is what we're up to, this is what we're doing, done. And you shut your mouth, guys. You don't say anything else, and you let them talk. Because if they talk, and if they ask questions, they're motivated. They're interested in what you're saying. If you just do all the talk, you wonder why all these people that just talk about themselves all the time, they don't have friends? Eh? Do you guys wonder that? It's because they don't connect with people, right? So it's the same thing here. You just want to just 1 minute, and then you just let them drive. And by the way, the fact that someone is asking you questions about your company is not because they're trying to judge you, to judge whatever you've done. They're just showing some signs of interest. So treat those questions not as a, because you probably have seen, guys, the program Shark Tank, right? And when you see those founders that are like pitching their business and then they start getting asked questions and they just get like very, very angry, right? And they just like overreact, they get reactivated by whatever question they're getting. That's a turn up. They never invest in those companies. And that's the same thing in real life. You do not want to react. You just want to be proactive, not reactive, okay? So then you go into the meeting. So maybe you're going to meet one person. Then that may lead to an investment if we're talking about angels, or if we're talking about angel groups maybe. If you're speaking with a VC, probably that meeting may lead to another meeting, to someone that is, let's say, another partner of the firm. And then eventually that's going to go to the partners meeting. You get your term sheet and you get the money in. So that's basically what the timeline is, what you're thinking. And the follow-up, we're going to talk about that in just a bit. So the outreach. So how do you do this? How do you get out there? How do you get investors? So just as I told you guys, you're never fundraising, right? And I know that we make the mistake, and I made it so many times when I was raising money myself. We make the mistakes of just going out there and saying, hey, I'm raising money. So all of you guys here that raise your hand, you'll failed, guys. You'll failed. You know why? Because the clock starts to tick. The minute you say that you're fundraising, the clock starts to tick. And what happens here is that if there is 2 or 3 months that pass by, and you go back to the investor, and you say, hey, we're still fundraising, then they're going to think like, what the hell? Maybe like everyone else, rejected this deal. And that's why they're coming to me. So it's not that exciting. And I find that there's one thing that drives, and this is unfortunate, but drives fundraising. And that is fear of missing out. Fear of missing out, urgency. And people want to get on a train that is about to leave the station. You know why? Because the ticket is going to be either more expensive or because they're going to lose their seat. The problem is that if that train continues to be there, they're going to know that's going to be the case. And for founders, and this is also very unfortunate, time is your worst enemy. And for investors, time is your best friend. Why? Because you get to see the company execute. So my advice to you guys is just what you see here on the quote, is that you ask for money, you get advice. You ask for advice, you get money twice. So how do you do it from a strategic perspective in order to really get people motivated, in order to get people to invest in your business? You basically are going to be meeting with people just to get their advice, just to get feedback, to connect on a human level. And you just keep them, posted. You follow up. Founders always fail at following up, at having a strategy, a roadmap of what those follow-ups are going to be. More on that in just a minute. But what I recommend that you guys do is that first you go for advice, then you just have like your network of people that you're building, and then eventually one of these guys that you're getting advice from, they're going to be like, hey, this is pretty interesting. Are you looking for money? And then you're going to be like, well, yes, we are, we kind of are. And then, the round starts, and then the party gets started. And then what do? You got your lead investor, they put the price tag, and then you go to everyone else that has been giving you advice and that are already, they have that relationship, they have some form of trust already built, and you just call them up and you say, hey, you know what? You've been so helpful during this past few months. And we actually just got an investor in, and we're going to be raising a round. We're going to be closing by the end of X date. I would love to be able to share this journey with you. Are you in? And when you do that with everyone else that has been giving you advice, it's just magical. And that's what founders don't get. And it's just very easy. It's just understanding the process. It's like, for example, when my wife was pregnant with our first child, she was extremely nervous because she just didn't know what she was going. And look, startups are like babies, right? Unfortunately, there's no exit. You only break even when they let you sleep at night and all of that stuff. But basically, with my wife, it was all about having visibility on the process, visualizing what she was about to have. So think about, the same thing. I think that the fundraising is all about understanding the process, is understanding the strategy, the psychology, what's ahead of you, how do you build those relationships. And I think that that's a good way to go. No? So the pipeline, I think that you should never get, you should never, let yourself down. I find that fundraising is just like a roller coaster of emotions. Sometimes you get really pumped, you get really excited because maybe someone told you that they're interested. But look, I think that you need to detach yourself from that. It's very easy. It's very easy. And also to detach your team. Because I see many founders that they're like making their whole team be part of the fundraising. And I think that's a mistake. There's just too many emotions. It's okay to give them updates, but it's not okay to just share with them all the stuff about the fundraising because it's a distraction. Because investors also expect you to execute while you are raising money. So what you need to keep in mind is that for every yes that you're going to be receiving, there's probably going to be about 100 no's. And that's just the way it is. So just don't get that motivation, let you down and stuff like that. And just only get pumped when the money's in the bank. Anything else is noise. Receiving a term sheet is noise. Receiving interest is noise. Receiving a commitment is noise. What you want is the money in the bank. And I've seen everything. I've seen term sheets and even subscription agreements signed for millions and millions of dollars, and the money was never wired. What are you going to do then? Are you going to sue the investor and throw good money after bad? I think that's a waste of time. You just got to continue to push. You got to move forward. So never celebrate until the money is in the bank. And this is really like a CRM. I mean, this is like sales, right? So I think that you really need to build your funnel. And by the way, when we're thinking about sales, there's this book that I love from this guy called Jeb Blunt. Take a look at it. And I can tell you guys the title later. So there's great things there's great resources. Like nowadays, you can actually go online and see who is investing in what. And here's what you do. When you see an investor that, for example, is investing in your space, and I'm just going to repeat this, getting in front of investors is the easiest thing. It's the easiest thing. Seriously. The toughest part is closing the deal. And why is the easiest thing? And I'll tell you guys in just 1 second. Because really for you, it's all about getting that circle in the middle, right? You need to establish the trust. But at the end of the day, there's a lot of ways in which you can get interest, right? I mean, you can get interest from founders, from consultants, from investors, from accelerators. I think that founders are the way to go. Everything else is a waste of time because it's all about social proof, guys. It's all about social proof, and also it's all about timing. And you need to have someone that the investor already trusts very much, that they're working with, to make the introduction so that not only you're getting your foot in the door via a reliable source, you're also going already with a really nice sense of trust that is going to reduce the time from beginning to end to getting the money in the bank. Now, how do you get in front of founders? How do you get the right founders to make the right intros, right? I think that there is 2 critical points why a founder is going to make an introduction and it's going to help you out. 1, we're all human. We've all been there. We've all been requesting intros and stuff like that. So as founders, we pay it forward. We have the pay it forward mentality. We help each other out. And then 2, when you're raising money, and you've already raised money from that investor, you're already in the hyper-growth mode. you're probably going to have, most likely going to have to raise more money, especially if we're thinking about a seed or Series A level, right? Because those investors are expecting you to continue to execute, to continue to drive growth for the business. So what's happening? What's happening is that that investor, that founder is going to potentially require more money from that investor. So how do they add value to their investors? By introducing them to other founders to increase that pipeline of deal flow. Now, how do you get in front of these founders? Very easy. You just take a look at the investors that are investing in your space, and you can use websites like, for example, Crunchbase or PitchBook or a bunch of others where you have all this information available for you. And then you just take a look at what are the most recent investments that they've done from, let's say, indirect competitors. And then what you do is you combine that, for example, with a LinkedIn. You get your premium account, and then you just start reaching out to founders. You get them on the phone, and hey, we're talking about seed and Series A founders. Those are not people that have chief of staff. Those are not people that have executive assistants and all these gatekeepers involved. And it's people that are viewing their inbox. So you just reach out, and not reaching out to take, you reach out to give. Because when you reach out to take, you lose people. You want to reach out to give. You want to reach out to connect. You want to reach out to learn about them, to build your network. And then at the end, maybe of a call or a coffee that you're having, then you say, hey, by the way, I saw that you have Investor A, Investor B, and Investor C already in your cap table. Would you mind making an introduction? So literally, if you were to schedule, let's say, 5 or 6 meetings, let's say on a Monday or on a Tuesday, right? On a Wednesday or on a Thursday, you would already have anywhere between 10 to 15 introductions to VCs from the best people. And that's why it's so easy to get in front of investors. The toughest part is to address the concerns. So the exchange. So every meeting is going to be very similar. Every question is going to be very similar. In many instances, they're going to ask you the same questions over and over and over again. So what I recommend that you guys do is that you always write them down. Write them down, you take them back, maybe you brainstorm with your co-founder or with your leadership team, and you just strategize as to how you can reply in a more powerful way for the next meeting. Because after, let's say, 10 or 15 meetings, you become a master. You know where you have your holes in your story, and you just got to tweak them. And that's why pitch decks are the way to go, because they're flexible, because you can just iterate them. And it's all about refining your story over and over and over again. That's how it works. Now, this is what we were talking before. And I think that those are the typical reactions that you're going to be getting from investors, okay? So it's either you don't have enough traction, you're too early, we wouldn't feel comfortable, we would feel comfortable if, whatever. I mean, guys, this is all, and excuse the language here, but this is all BS, right? At the end, what they're asking you is that they are giving you indirectly a request to continue following up. Because when we're talking about investors, this is what matters. It's connecting the dots. It's what I call connecting the dots strategy. You're starting on month 1, right there. But when you meet with the investor, you're telling them, you're making a promise that by month 3 or by month 4, you're going to be somewhere. Whether that is with your numbers, whether that is with your milestones, whether that is with your team. And your duty is to continue following up every, let's say, 2 weeks or 3 weeks or maybe monthly, so that, and you can follow up with what I have there, like team, press articles, maybe you got a TechCrunch or New York Times, whatever that is, so that you are not only top of mind, but then also because the investor is going to be able to connect those dots. And then at one point, they're going to be like, this guy is executing. This guy promised me that he was going to be up here when we were talking out there, and everything matches. I'm going to go and I'm going to invest. And that's why you want to continue following up, because every follow-up is going to potentially get you another meeting. And that potential meeting is going to get you closer to the money, because you're going to be able to address more concerns. So the structure, so we talked about how much to raise, probably raise a little bit more now, because you never know how the market is going to react. And then really, I mean, you have the convertible notes, the safe notes. This is a very easy thing to structure. And what I like about this is that it's actually cheaper on the legal side. So I'm a recovering lawyer myself, still seeking therapy. And I think that legal fees really suck. I mean, it's just the way it works. And you end up, with a crazy bill. But I think that at an early stage, it's fantastic to be able to use notes or SAFEs or whatever you want to use, because it's just very standard. You're just looking at 3 or 4 terms, so maybe the interest that you're giving, the discount that you're providing on the valuation of the next round, the cap, and maybe the maturity date, and that's about it. I mean, it's very simple. You're probably looking anywhere between $5,000 to $10,000, and it's also very quick. So if you need the money very quickly, and if you have someone that is very excited, or maybe you want to excite someone, because here's another strategy. Maybe there's an investor that you're speaking with. Maybe you want that investor to come in. So what you do is you say, hey, I really want you in, and I want you in early. Why don't we do a note round? I give you a discount on the next round, and we get you in, and that way we can start to work together. And maybe you help us with structuring the next round. And perhaps that investor is going to be like, hey, you know what? I'm getting a 20% discount, on the next equity, that is going to happen very soon. So I'll just jump in, I'll help out, and I'll pocket that discount. So that's a good strategy that you can get to, maybe like give that last push that you need to someone, so that someone is really that person that comes in, because fundraising is like swimming in an ocean full of sharks. They're all swimming around you. And you're just waiting. I mean, they're just waiting to see who is biting first. So maybe that's a good strategy that you can use. Then the equity rounds, they're obviously a little bit more complex. I think that equity rounds, if you're dealing with a very tight timeline, if you're running out of cash, probably it's tricky. It's tricky because there's a lot of negotiation, and especially the lawyers can really complicate stuff, and you want to look at every single clause. And obviously for this, you want to have corporate lawyers, not the cousin that does family law, no? Now, when we're thinking about dilution, and you're structuring the round, I think that you want to be very careful. And I've seen like every single nightmare that you can think of. Founders that end with just 5% of their business at a seed stage, or maybe at a Series A. I think that there's always this rule of thumb that you want to follow. And that is that you're not diluting yourself by more than 25% per round. It's just the way it works. Obviously, the less, the better. But anything over this is an absolute no-no. And then the due diligence, like what we were discussing, this really happens all along. So obviously when you receive the term sheet, right, after the equity round, then you go into the diligence and all of that. But before I go into it, I have to share with you guys something. Again, a term sheet is not a commitment to invest. It's not binding. So when you receive a term sheet, don't go all crazy getting a better office space. Don't go crazy starting hiring, because what a term sheet is all about is just a promise. It's just a summary of what are those potential terms that you're going to get. And I can't tell you how many times, I've had founders that told me I had to shut down my business because I received a $2 or $3 or $4 million term sheet. I started hiring, and then that term sheet didn't come through, and I was left holding the bag. So you never move a finger when it comes to costs until you have the money in the bank. So the diligence, again, is going to focus on the team, it's going to be focusing on the business, and it's going to be focusing on the technology. Now, one thing that I have to tell you guys as a recommendation is that you never want to be the bottleneck when you're raising money. And what that means is that when someone is pumped, when someone is excited and they want to move forward, you want to move them as fast as possible. You don't want to be in the middle creating trouble, or maybe there's requests for documents or stuff like that. So what you do is you create a folder, let's say on Dropbox or Google Drive or whatever you use, and you put every single document that you can or that you think that they're going to need of the business. So that way you just give them access to the due diligence folder, and that's it, ready to go. And then from that, you go into the offering documents, cash is wired, and party starts. So they are going to be obviously focusing on the business, the technology. On the technology, they may send you an advisor to take a look at what you're up to, especially let's say if it's something like, let's say, engineering driven or stuff like that. And just like the investors are doing due diligence on you, I think that you need to do due diligence on them as well. And the truth of the matter is that when you are bringing an investor on board, you're getting married. And when you're getting married, or when you're, let's say getting someone in your bed, you want to be very careful, because ultimately marrying an investor and trying to seek a divorce is going to be much tougher than divorcing your husband or wife. It's just the nature of it. It's very complicated. So how do you avoid this? You just make sure that expectations are clear and that there's a clear alignment between the parties. So you need to Make sure that they're going to give you access to a network. Maybe there is talent, or maybe there's like other stuff that they can contribute. Perhaps other investors for a subsequent round of financing, maybe they just lift up the phone and make whatever introduction is required. Then also a network to other connections and things like that. But I find that network of the investor, it can really do wonders. And here's what I will tell you all. I would rather get a term sheet at a much lower valuation from our unbelievable investor than a term sheet with a really high valuation from a crappy investor that is just going to be a passive investor adding no value. And sometimes, in many instances, as founders, we just get lost. We get lost in the valuation. And that's what you should not be focusing on. Because just as Mark Cuban, for example, says, you want to have 1% of a billion than 100% of nothing. So that's basically it. So any questions, guys? If you have any questions, feel free to go to the mic here. Happy to address them.
Thank you very much. You mentioned that it's better to have a range when it comes to the size of the funding that you're asking for. So like $2 to $5 million, for example. Wouldn't you risk sounding like you're not quite sure how much you need? And just to follow up on that is, you say maybe raise up to 18 to 24 months. Would that suggest 18 to 24 months funding if you made zero revenue, just purely costs?
Yeah.
Thank you.
Got it. Great questions. So on the range, basically what you do is on the model that you're creating, on the financial model, what you do is you can say, hey, we can do this much with, let's say, 2 million. We can do this much with 3 million. We can do this much with 4 million. So basically, you're sharing with them what you're capable of with more money. So that way, it's not like you don't know what you're doing. You know what you're doing, and you're actually putting it and being grounded on the numbers. So that way, you're just not losing people. So that's for that question. For the other question, the 18 to 24 months, I would always recommend not focusing on the revenue. So forget about whatever money is coming in. You want to make sure that you're raising whatever money that you're going to need for the business without counting with the revenue. Because things happen. You may have to pivot your business. You may have to change another route, maybe market conditions, the revenue is being impacted. So raise money for 18 to 24 months without counting with that money.
Hi. My question, you mentioned that for investors to be interested in you, they like to see the market size over $1 billion. Now, if you are starting on the estate, for example, which is in the millions, but globally it's in the billions, but they want to see your strategy for the first year, which is in the millions, how do you approach that on the deck? Because they always want to see what you're working on right now.
So you can break it down. So maybe you can put like the big market size, which is the global, right? And then you can just say the national and then the local or whatever, because I don't know if you're a business, but maybe that's the approach that you're taking, so that you're basically doing what I always recommend founders to do, which is that you reverse back engineer the process. So you tell them where you want to be, let's say in 7 to 10 years or 5 to 7 years, but then you're just putting yourself and reversing back to where you are today, so that you're kind of like sharing what immediate steps you're going to have to achieve in order to really unlock that really big potential, no?
Sounds good, thank you.
For investors, what quantitative and qualitative attributes from customer acquisition, meaning paying customers, do they like to see in the seed round and Series A?
Yeah, so I think that at a seed round and at a Series A, you definitely don't want to show that you're acquiring a ton of customers paying. I think that basically where they're going to be really honing in is going to be more on the distribution channels, like the organic distribution channels, because going back to what I was mentioning on the presentation, it's very risky to say that you're going to be dumping a lot of money into marketing, because anyone can do that, right? So I think that probably their focus is going to be more on the organic distribution channels rather than on how much you can pay, how much you can generate. Now, I got to tell you something. If you share the numbers and you show them that you're really grounded and that you know the stuff, that you really have a good handle on the advertising side of the business, that's a plus. But I think that this organic distribution channels is what they're looking for.
Hi. For seed round or A round, when we're looking for investors, typically there's a lead investor and follow-on investors. Can you give some information about like what sizes each one should be doing and why you want both classes?
Yeah, so basically when you are getting, I think that at a seed round, by the way, it's a mistake to have a VC. And there's all types of opinions. This is mine. And the reason for this is because at a seed round, you're still on the prototype version, for the most part. And you don't know how you're going to have to tweak the model or the business in order to get it right. The problem is that if you get those VCs early on at a seed stage, things may change. That's probably not the business that they thought they were invested in. And then you're going to lose them. And then when you go at a Series A, people are going to be like, where are those VCs? Why aren't they investing? Maybe there's something wrong with the business. So at a seed stage, big no VCs. Now, for a Series A, when you're thinking about a Series A, I think that you need to think about an investor that has good deep pockets, especially if they're a lead investor, right? Because a lead always sends signals everywhere. And for a lead investor, you want to make sure that that investor is going to perhaps continue to invest in the business. Because by continuing to invest, by following on your Series B, on your Series C, or whatever that is, then that is going to continue to show confidence and to a certain degree tell the world that the business is doing well and that investor thinks that you are an absolute winner. So it really depends on investors and what is their mandate of the fund, what agreement they have with their LPs. But I've seen anywhere from 10 to 20% maybe that they reserve for follow-on runs, no? And it changes. There's all types of stories, no? Alrighty, so I think that we got it to an end, and just like that quote says, the best way to predict the future is to create it. So thank you very much.